This is Mould on Markets, our regular look at the financial markets with Investment Director Russ Mould. Russ, how are you?
Very well, Clara. How are you?
Not too bad at all.
Good to see you again.
Last week at Ascot, how was that?
Pleasurable, and the weather was kind, and the picnic lunch, if I say so myself, was excellent.
I'm sure that clients and their advisors might be thinking about that, but what else should they be thinking about?
More importantly, now I could talk about Greece, and more Greece, but we're probably all feeling just a little bit of crisis fatigue right now, and also the things moving so quickly. This will be out of date before we published it. So to add a little bit of value right now, I'll help you add a bit of value. I'd like to switch from Europe to Asia, and in particular, China, Japan, and India.
3 superpowers, 3 big stock markets, and 3 powerful political leaders. Is there anything else that links them?
Well, too much more of that. We're going to swap seats. But yes, very good. They do have much in common. Prime Minister Narendra Modi in India, Prime Minister Shinzo Abe in Japan, and Premier Li Keqiang in China are all trying to drive through social and economic reforms, and the financial markets have generally welcomed these initiatives with wide open arms. The first chart here shows India's BSE Sensex since Modi was elected on the 16th of May 2014. The second shows Japan's Nikkei 225 since Abe swept to power in a landslide win just before Christmas 2012. And the third shows China's Shanghai Composite on the left and the Shenzhen Composite, a more domestic market, on the right, since Li Keqiang took the post of Premier in March 2013. Now, all have done pretty well, although India actually ran up quite strong before Modi took over because the market sniffed it was coming. But as you can see in particular, China's just absolutely stormed ahead. This becomes even clearer when you look at the next graphic, which compares total returns from the Chinese, Indian and Japanese markets for this year only, and in sterling terms, because in the end, that's what your clients are interested in.
Yeah, that final chart raises a lot of eyebrows though, doesn't it, and issues, because there's a big dip at the end, which means China's had its worst week for 8 years.
Yeah, after a huge run and then this stumble, you've got some commentators legitimately asking, are we seeing a bubble in China? Particularly the Shenzhen index, which again is more domestic, focused on small cap and mid cap names, as well as an awful lot of techie stocks. So people are really asking some serious questions there. Now, there's also this photo that's rattling around the internet, and that kind of sets your teeth on edge as well. This sort of degree of public participation in the market is not always a good thing, and private punters are allegedly opening up broking accounts in record numbers, but over 4 million in 5 days, about a fortnight ago. Now, the Chinese authorities are aware of the danger as they keep tightening margin requirements to try and limit participation and keep the markets calm.
So, Russell, will the Chinese market boom continue?
It's worth considering the 5 reasons why Shanghai and Shenzhen have soared to see whether they're sustainable or indeed whether they're priced in, and then we can make a more rational judgment. So the first reason that the indices are doing so well is, despite clear signs of a slowdown in Chinese GDP, is that in the end the Chinese central bank is doing its best to help things along with interest rate cuts. Nobody believes that Chinese GDP number anyway. The underlying economic indicators such as rail traffic, bank credit and electricity consumption just don't back it up. But the central bank is getting stuck in, cutting rates, just as you're seeing in Europe and Japan. Therefore, money's going looking for a home somewhere else. You've also got Li looking to rebalance the economy away from construction towards consumption. Much healthier, more balanced picture long term. People quite like that. Third, the new Silk Road investment program. It's massive, spans Asia, could help boost Chinese trade in the long term. And fourth, the Hong Kong Shanghai Connect scheme has been a wild success, boosting stock market flow and overseas interest. Hong Kong Shenzhen is coming, and increased liquidity means Chinese mainland stocks may one day end up in the MSCI benchmarks. Now, according to some analysts, that could add $50 billion worth of demand just from tracker funds alone. Yeah, not small money, although in the context of the mainland market cap, which is around $4 trillion according to Citigroup, it does need to be kept in context.
Right, Russ, we are running out of time. Quick final words on India and Japan.
I think India's travelled and arrived in some ways. It began to run before Modi took power. It's definitely now pausing for breath. Can he actually deliver the reforms that he's been promising? I think that's going to be the next leg now. Do you see delivery? In terms of Japan, yeah, Prime Minister Abe has got his challenges as well. Inflation is still nowhere near his 2% target. It's still got horrid debt problems, rotten demographics, and so he's got his work cut out as well. Next challenge, or next step, therefore, for us is to look at the TANCAN, the Short-Term Economic Survey of Enterprises of Japan, to give it its full name, and that will come on the Tuesday the 30th. Remember that the March reading of corporate sentiment rose from 6 to 7 overall, stayed flat at 12 for large manufacturers. The Nikkei has a pretty close relationship with the sentiment indicator, as the chart shows, so let's see what comes out from the TANCAN on the 30th.
Thank you, Russ.
Pleasure.
Thank you to you for joining us. We'll see you next time. Goodbye. you.